So this is the last presentation of the last section of the course, and I've saved it for this week because I think it's a good way to revise the subject. You'll notice that the slides cover chapter 14 and 16. I've decided we will only cover chapter 14, so you won't be examined on chapter 16. I haven't got it in your subject outline. So we're just going to look at the auditing the sales and collections cycle. Doesn't mean that the other slides that relate to inventory, property, plant and equipment aren't useful. They are useful because they'll give you more examples of the same sort of things that we've been dealing with. It's just that there's no point as a presentation going through that. It just gets a little bit monotonous. The good thing about it getting monotonous is that you can see the patterns appear, but you can use it just for your own revision. Okay, so I just want to go through the sales and collection cycle to show you how you would apply everything that we've been doing so far. So the objectives, and this is only in relation to sales and receivables, is to be able to identify the applicable audit objectives, apply the concepts of materiality and inherent risk, describe the elements of an audit plan, discuss considerations relevant to determining the audit strategy, design and execute tests of transactions, design and execute tests of details of balances. So that's virtually looking at the audit of the sales and collection cycle. So we've got to work out what our audit objectives are. They're going to be based on the management assertions, apply the concepts of materiality and inherent risk, come up with an audit plan based on that level of materiality and inherent risk, look at the considerations in determining an audit strategy. So based on the inherent risk and the control risk, what sort of audit strategy are we going to devise? Then we've got to actually come up with some procedures, and we've got to come up with procedures to test transactions and procedures to test details of balances. So we're going to do that for the sales and collection cycle. So with sales and collection, the management assertions that we're mostly concerned about are occurrence, completeness and accuracy. We want to be sure that sales have only been recorded if they did occur, that management hasn't included fictitious sales in overstated sales. In terms of cash receipts, we're worried about completeness. Have all cash receipts been recorded? And have all of these transactions been recorded accurately? Because with sales transactions, depending on the business, there can often be a lot of pressure around the point of sale, and people might forget to record the sale. They might be able to slip money in their pocket. If cash has been received from customers, does it actually go into the bank account? Does the person doing accounts receivable, actually that goes into the next bit, we'll talk about accounts receivable. For accounts receivable and provisions for bad debts, we want to be sure that the accounts receivable does actually exist and it's correctly valued. And of course, we want to make sure we haven't understated the provision, like that example that we did in the questions a minute ago, where we know that a debt's going to be very difficult to collect and is not likely to be able to be collected in full. Then I need to have a look at the valuation of that provision. So the valuation goes for both sides. When we look at the revenue cycle, we've got three types of transactions or classes of transactions. We've got credit sales, we've got cash receipts, and then there are sales adjustments. So anybody who's worked in retail before, you know you're going to have sales, and the sale might be on credit or it might be a cash sale. If the sale's on credit, eventually the customer pays up, so you've got a cash receipt to pay off an accounts receivable. And we have sales adjustments. People bring things back, they want a refund, they might have returned it because it was faulty, or they might have just changed their mind, or some sort of sales adjustment might occur. And of course, the sales adjustments are fewer in terms of transactions, but it requires its own controls to make sure someone isn't defrauding in that area. In terms of account balances, so there we've got the things worried about transactions, and then for account balances, the account balances in the financial reports that we need to be concerned about is the sales figure, sales discounts, accounts receivable, returns and allowances, cost of sales, inventory, bad debts expense, provision for bad debts, and cash. So they're all of the accounts that are going to be impacted by the revenue cycle. And when auditors carry out an audit, they will break the audit down into the different cycles. So there will be the audit of cash, of revenue. There'll be the revenue cycle. There'll be the wages. There will be plant and equipment. There'll be liabilities and equity. So you break it down into areas where the same accounts are being affected. Because if we're going to audit the sales account or the provision or the accounts receivable, we may as well do all of those things together. We've got these transactions in our hands. We may as well make sure we're checking to see that all of the potential account balances are correct. You don't want to pick up pieces of paper for different reasons and, you know, check the sales, and then another team comes through and checks it for the inventory or the returns and allowances. We want to be as efficient as we can. So it makes sense to break the audit into these cycles that are related to each other. So in the revenue cycle, that's what we do. So we have to understand each of the cycles that we're auditing. Now, there's a fairly complex looking diagram here that explains how all of these transactions affect all of the account balances. So you'll see down the bottom of the page, we've got the general ledger balances and we've got the accounts receivable ledger. The accounts receivable ledger is a subsidiary ledger. Same as accounts payable. The wages payable ledger and the inventory records are all subsidiary ledgers. So we can see that all of those transactions, and I won't go through it in detail, but if you've got any doubt as to how transactions take place, you should have a look at this diagram. And when you look at this diagram, keep in mind where this is relevant and for what industries and for what types of sales. If it's sales over the internet, so electronic transfers, events occur in different sequences. If it's a business-to-business transaction, that's different to a retail transaction. So have a look, you know, when you get a chance to look up close, because I know that's hard to read there, each of these things, and try to work out what type of sales are going on here. Of course, if we're invoicing, we're not talking about a straight retail sale. So take a bit of time, because if you don't understand the whole cycle, you're not going to be able to audit it. So in our revenue cycle, we're talking about credit sales transactions, and there are 3 steps to this, or 3 different parts of it. Accepting a customer's order, approving credit, filling and dispatching orders, invoicing customers, and recording sales. And of course, this is in a situation, generally a business-to-business transaction. But not always. Sometimes this could be retail sales that are remote. So it could be over the phone, it could be internet-based sales. So you've got to accept the order, approve the credit, and in internet, when you buy something over the internet, what do they do before they send it out to you? Yeah, so if you buy something over the internet, what happens before they send you the goods? They get the payment, that's right. So it's not just that, they make sure that you pay up front. There's none of this invoicing and then you pay them. So you need to think, is this actually what happens in the company that you're interested in? So have a look at the transactions and whether they do occur. So in terms of approving credit, a credit's approved by the fact they've been able to charge your credit card or take your PayPal payment or whatever it is. Then there's cash receipts transactions, and cash receipts can be over the counter, by mail receipts, depositing cash in bank, which of course has become much more common these days, where you just do bank transfers, and recording receipts. But I'm still amazed at how many companies deal with cheques. I'm stunned at how many companies still send cheques through the mail. I come across it all the time, and I'm always surprised. I think, don't you just do a bank transfer? And they don't. Ah.
They import a file into the bank and they do the transfers, but the systems put a number of check.
Okay, so they still use the term a check number or something. Okay, interesting.
For the employees, for example, when they receive the pay, appears a check for example.
Oh, okay, okay. This system hasn't caught up. And then we've got sales adjustments, cash discounts, sales returns and allowances, and bad debts. And these are the transactions that would be recorded through subsidiary ledgers and journals. So if we're going to apply discount, or the discount would be applied, might be applied at the sale, but if it's a settlement discount, that's going to be applied as an adjustment to their accounts receivable. Same with sales returns and allowances. And when we write off a debt, when we've actually got a bad debt, that's going to be done through an adjustment. And so you can imagine there are really different areas that we need to consider, that misstatements can occur, where things could be entered incorrectly, or where there can be deliberate frauds. And so to get a really good knowledge of how the system works, you're going to have to do a walkthrough. You have to start, if I'm a customer and I pay this, what happens next? What do you do next? Where does that get recorded? If I want to return my goods, what's required? So you have to do a walkthrough through the system, because it will be different for every company. And then we come to all of the management assertions. So these management assertions, we've got the transaction related, these are audit objectives. So these audit objectives relate to the management assertions. The names are the same, but what we're doing is looking at it from the point of view of the auditor. So we've got occurrence or existence if it was a balance-related audit objective. And so what we're worried about with the sales cycle is that sales recorded in the accounts represent goods that were shipped to the customer during the period. Now, the notations next to it are coming from the textbook, because there are other schedules associated with it, so don't worry too much about that. You might like to go and have a look at it to try to trace it all through, but I haven't presented all of that in all of these. Some of them I have, some of them I haven't, but the ones that I have we'll get to a bit later. So they've just coded it. So it's occurrence or existence 1. Cash receipts recorded in the accounts represent cash received from customers during the period. So that's number 2. Sales adjustment transactions recorded in the accounts represent authorised discounts, returns and allowances, and bad debts applicable to the period. So as an auditor, these are my objectives in terms of testing for occurrence in the sales and collection transactions. So I've got one for sales, one for cash receipts, and one for sales adjustments. And there will be others, but we've just got a sample of them here. And then what I'm doing is making these specific to the cycle. So completeness, all goods shipped to customers during the period are recorded in the accounts. All cash received from customers during the period are recorded in the cash receipts, as cash receipts in the accounts, and all discount returns and allowances and bad debts arising during the period are recorded as sales adjustments in the accounts. So the fact we've got all in front, that's a bit of a hint that if something says all, look carefully, it's likely to be a completeness objective or management assertion. So I'm looking to have everything included. Accuracy, we're looking at how the transactions are recorded. So we want to make sure that all of those transactions are properly or accurately recorded, that we haven't made mistakes in transposing numbers and putting the wrong details in. Cut-off, particularly relevant to transactions at the year end. All sales, receipts, etc. are recorded in the current period, and those arising after the period are included in the next accounting period. You can see from the way these are worded, it is very precise, but it's very plain and straightforward. They haven't complicated anything. It's just stating things exactly as that objective, but instead of just saying all transactions are recorded, we're specific about the transaction, about the sales transaction or the receipt or the adjusting transaction. And we've got the same for the balance related objectives. Accounts receivable included in the accounts represent amounts owed by customers at the end of the reporting period. Accounts receivable are claims of the entity on the customer for payment. So this is the way that we need to word it. Now, if we go on to the next step for these audit objectives, I've got several transaction-related audit objectives here. So there's some good examples of how to actually write out a transaction-related audit objective. All cash received from customers are recorded, etc., etc. So you can read through these to give you an idea of how to word these things. And they're related to the table that we looked at before. For the balance-related audit objectives, we've included all of those. So if you're looking to try to find balance-related audit objectives, these are some good examples. The last one, the allowance for bad debts represents a reasonable estimate of the difference between gross accounts receivable and their net realisable value. And that relates to allocation and valuation. And then one that we haven't talked about much is the group of management assertions and audit objectives that relate to presentation and disclosure. And in terms of presentation and disclosure, they relate to profit and loss statement items and to balance state items. So in terms of presentation and disclosure, I want to be sure that disclosed revenue events have occurred and that they pertain to this entity. So they are the transactions of this entity. Completeness, all revenue cycle disclosures that should have been included in the financial reports have been included. So now I'm not talking about the numbers for the transactions, I'm talking about the disclosures. I have actually disclosed everything that I should be disclosing. That sales cycle information is appropriately presented and information disclosed is clearly expressed. Classification and understandability, which has become a big issue in accounting standards at the moment, in making sure that only relevant information is included and that you're not trying to confuse readers by putting in irrelevant and immaterial information. Accuracy and valuation in terms of disclosures is that you're disclosing things accurately and at the appropriate amounts. So you can see some overlap with the balance related and transaction related objectives, but the presentation and disclosure ones only relate to how it's presented, not what the numbers are or how it got there or whether they exist or etc. But did you disclose it according to these terms? So we've got separate objectives for those. Now, the audit plan. We talked about this earlier in the course. The objective is to plan the audit so that it will be performed effectively. And we also want to plan it so that we make some money out of it too. So we want to have efficiencies in there. So it's not the primary objective in planning the audit, but it's certainly important in terms of the firm. We need to look at all the preliminary engagement activities. What sort of things do we have to do before we actually commence this audit? Or before we write the engagement letter? Then we've got a whole lot of planning activities that we have to go through. And in those planning activities, what we're trying to do is to work out the audit strategy. And by this we mean we want to know to what extent are we going to rely on tests of controls, and to what extent are we going to rely on substantive tests. And the extent that we're going to rely on controls or substantive tests will depend on our assessment of inherent risk and control risk, and on our assessment of materiality, what level we set as materiality. So this is going back over everything that we've been covering this trimester. Okay, just wasn't sure if I was recording then, so I better go back again. Okay, so the considerations for the audit strategy. Remember that we need to, first of all, get an understanding of the entity and its environment. And you have to think, why do I have to get an understanding of the entity environment and its environment? I have to, we accepted this early on, that yes, you have to get to know the client, you have to get to know what industry they're in, and we want to do that because why? Why do we need to go through this step? Yeah. So, like what? We need to assess the inherent risk, and so we need to understand the industry and we need to understand the client in order to do that, because some things relate to the industry they're in, some will be, or the economic area that they work within or something, and the rest, and some of the inherent risk is within the entity. So yes, we have to understand inherent risk.
AS 315.
Yes.
And this FS name is very big, like understanding that there is an environment for understanding the entity, and like a big, so we need to write down all the old name of the standard. I just we need to mention the AS 315.
Oh, just the ASA 315. Yep. Yep. That's right. Yeah, you don't have to put the name all the time. Yes, it is. It is. So we've got to try to work out what is the possibility that there are misstatements here. I need to understand, I need to know something about the entity before I can even think about where the risks might lie. So it's very important that we assess it. We're going to do some analytical review procedures on it, and this should highlight some areas that might have a high risk of misstatements, things that don't quite look right. I need to decide whether this part of the audit, or which parts of the audit, I should say, are going to be material. And in every organisation, sales and cash transactions are always material. And if you have credit sales, accounts receivable will always be material. Without sales and cash receipts, the business can't survive. No matter what kind of business you're in, this is not going to be an immaterial item because it's the livelihood. It represents the fuel that keeps the organisation going. In other areas, it may or may not be an area of high materiality. If you're auditing a company and the area that you're auditing is inventory, in some organisations, inventory is going to be material. If you're a manufacturing company or a retail organisation, inventory is going to be material. But if I'm in a service industry, I provide professional services to people, inventory is not going to be material. So other areas might vary, but in everything, sales and cash are always going to be material. And also because of their susceptibility to misappropriation. And the inherent risks. I want to know what sort of pressure is on management to overstate revenue, cash and receivables, and to understate bad debts. And if you think back to that fraud triangle that we looked at when we looked at fraud and the auditor's responsibilities in relation to fraud, if there's a lot of pressure on management to overstate revenues, then I'm looking at the incentives and pressure associated with that. If bonuses are attached to it, if the company is in a bit of a downward spiral, then there's going to be pressure on management to overstate those items and understate bad debts. And I'm going to get that feeling with all the procedures I carry out in understanding the entity and its environment. High volume transactions, where I've got high volume transactions, there's a chance that people could be misappropriating and they could be systematically defrauding the company. If I've got high volume transactions and all of those transactions are being recorded incorrectly, that's a big problem. For instance, you take a financial institution, you have high volume of transactions in the calculation of interest rate, of interest payable or receivable. These calculations are being done all of the time. That calculation could be at the tiniest bit, and it can cause highly material errors in the whole system. So where I've got high volume transactions, I've got to be sure if they've got a computer system that that system is calculating things accurately to the right level of significance. If they've got low volume transactions, not such an issue. You think the inherent risk associated with sales for Myers compared to the inherent risk associated with the sales figure for an accounting firm. You invoice customers once a month and it goes through a billing process and all this. Very low risk there. For a retail organisation, it would be high risk. Contentious revenue recognition issues. If you're in an industry where revenue recognition is an issue, can you think of any industries where they're particularly susceptible to subjective revenue recognition issues?
Service industry.
Service industry, why?
Like they can recognize revenue before providing services.
Yep,
So.
That's right. So they've got work in progress, and then they've got fees receivable, and you've got to make sure that they haven't been pushing more into fees receivable, and there's revenue before they should. So revenue recognition, where you've got a subjective judgment. Construction industry is another big one. Anyone where there are projects, long-term projects, you have construction companies and they're going to be billing their clients every month, and they're estimating what portion of the project is completed What's the value of that? Very subjective. That's contentious.
Ruling that revenues.
I 118.
Which one?
AASB 118.
118?
118. 118.
But this is a new one. This is the old one. So
Revenue.
Yeah.
Like we can mention ASB, ASB. Like I used to write
AASB, we could say. Yeah.
ASB,
Yeah.
ISA.
Or IAS.
Like ISA is ISA 18, but in Australia it is IASB 118. So we need to add 100 as well, and ISB.
Yes. Yes, that's right. That's right. And where cash is susceptible to misappropriation, obviously there's high inherent risk there. So we need to understand all of that. And look here, we are looking at the audit strategy considerations surrounding the revenue cycle, sales and cash collections. So we're making these considerations specific to this cycle. So if you were asked for inherent risks relating to a cycle, you don't just say, oh, where there are contentious issues or where there's a chance of misappropriation of assets. If I'm talking about inventory, I want you to say the misappropriation of inventory items. Okay, so you need to be specific. And sales adjustments that can be used to conceal theft. There are several well-known techniques of covering up, concealing thefts using adjustments. One is lapping. And lapping refers to a practice where, say with accounts receivable, you receive someone's payment of someone pays their account close to the end of the month, the cut-off date for the period. And instead of putting that to their account and banking it, you take it yourself. And then the next month, the client receives their statement that says, oh, you owe us this much. And when they phone up, they're told, oh, look, that was just towards the end of the month. Don't worry, that statement, that payment will come through on your next account. In the meantime, you make sure that you correct that person's account for the next month, and then you wait for a late payment by somebody else, and you let that one you don't credit that account. Instead, you credit the one that was outstanding last month. And this goes on and on. Now, of course, what eventually happens is the person doing this ends up taking so much money out they can't cover it up. And they're waiting for someone to pay a big account so they can fix all the other accounts up. And they end up getting themselves into strife by that. But it can go on for quite a long time. And if you just take one big chunk, you might just get away with it. So lapping is where you're redirecting funds towards the end of the towards the end of the month when the statements are due. And people understand, okay, yes, I did send it in. Okay, well, it didn't get processed this month. Next month it will. And then next month it all looks okay and you don't touch their account again. You go to somebody else's. Now, one of the ways of picking that up, if it's happening, is you examine customer complaints. And if continuously there's a customer complaining about their statement's not right, you can think, hello, something's going on here. And so if it's about the same amount or just slightly greater every month, you know that this has been occurring. So sales adjustments would be very careful of.
Yeah. Another example is the sample, like things taken out as samples, like recording as sample, but they use it for their own like personal use.
They're taking out a sample.
Like things taking out from stock as a sample, like.
Oh, I see. The inventory itself. Yes, that's right. So that's right. They misappropriate inventory that way. Yeah, that's right. Absolutely. And then sales adjustments, you could just give them a credit to their account. You know, so you might have on someone's statement they've paid their account, let me think what it is. Yeah, they've paid their account, but you haven't recorded it as a receipt. And then what you do is you give them a sales adjustment. So their account balance decreases by the amount that you took out. So they're happy their balance is right, but you've actually given them a credit. Of course, the way to avoid that happening is to make sure there's segregation of duties and proper authorisation. So if there's not an authorisation for a sales adjustment by an independent person, then that shouldn't occur. But they can use those sorts of things to try to conceal what they've done. And in a small to medium-sized business, that can happen because you don't have enough people to go around, and you might have the same person doing all those jobs. So in relation to this cycle, there's some of the inherent risks that you'd be watching out for. Now, the audit strategy considerations for the sales and collection cycle. Generally, we have extensive internal controls in relation to sales and collection cycle because we've got a variety of things that can go wrong, and it's often the easiest area for people to make mistakes or deliberately misappropriate. Then we've normally got quite a few internal controls around the collection of cash and the recording of sales and the adjustments to accounts and things like that. So when I go into sales and collection cycle, I'm expecting to see lots of internal controls. Whether they're good internal controls, whether they're implemented properly, I don't know yet, but I would be expecting to see internal controls. Okay. Also, we've got high volumes of transactions. And if I've got high volumes of transactions, I'm hoping I can rely on internal controls, because if I have to do all substantive testing, I have to do a lot of substantive testing. So where I can possibly have a lower assessed control risk approach, that's what I'm going to take, because the efficiency and the effectiveness of the audit will be improved by that. And compare that to an area where you have low volume transactions. If I've only got a few transactions a year, say the motor vehicles, plant and equipment, there might not be many transactions a year. It doesn't matter that much if I can rely on controls or not, because I've only got a few transactions to check. I might as well check them all and just do the substantive tests. Which is what this next point is. Where transaction volume is low and or controls are ineffective, I'm going to take a predominantly substantive approach. And for sales and collection, as I said, in a retail industry or even a manufacturing industry, I would be hoping that I can rely on the controls, because it's not likely to be low volume. Now, here is I wonder if this will work. This is a vodcast, and I've got it here by the Institute of Chartered Accountants in Australia, whereas they are now called Chartered Accountants Australia and New Zealand, and I'm not sure if this is going to work or not. Let's just have a look. Didn't take me to where I thought I was going to be. Vendor services, technical, insurance. This is the website's changed, so let me just see if I'll just try one thing. Will it let me do a search? I'll get myself out of the way. Yes. Oops, do it again. No, I've taken it off. Oh, that's a pest. They had a very good, they used to have a very good little video that they showed in a retail environment where cash was being misappropriated, and it was really good for the segregation of duties because it then had someone else doing the bank reconciliation, all that sort of thing. I thought that would be interesting, but it's gone. I should have checked it before. Visit education store. Okay. Oh no, that's collaboration. Ah, bother. No, they haven't. Blast. Oh, they used to have lots of education resources for universities, and looks like they've removed it since they've gone in with the New Zealand crew. Really interesting photographs, aren't they? Okay, all right, so we won't do that. We won't do that. But I will ask a question though, is for anyone who has worked in retail, say for a fast food chain, they're obviously going to be, let's use McDonald's or one of those other, you know, Kentucky Fried Chicken or one of those big chains. They would be very concerned about people taking cash. They have young employees. They generally would have the incentive available to them to misappropriate cash. They might think that it's a small amount. The motivation or the rationalisation might be, oh, well, McDonald's is a big chain, they're not going to miss $10 a week or whatever like that. What sort of controls do you think they have in place to prevent people from stealing cash? Okay, reconciling it, reconciling the cash to the sales. And of course, with that case, you want to make sure that there's only one person on that cash register at a time, so that if their cash register doesn't balance, they need to explain why. And in some organisations, and I know banks, they make the cashier put in the balance if they're out. Yes? Yeah.
But sometimes, like, if they give customer more than they're supposed to give, like, it happens. I'm working in Caltex. I know, like, sometimes, like, God knows, I'm not a dishonest. I'm honest. But sometimes, if the customer gave $20,
yes,
like, by accidentally, I'll like entering 20, I enter 50.
Yes.
I give the
too much change.
Yeah, sometimes it happens.
Yes. And there are procedures, there's training, there's staff training, isn't it? So you need to train the staff well on what to do. And most places you're told, leave the notes on top of the register, get out the change, look at the change, then put the note in so you don't make that mistake. But yes, invariably, sometimes you put it, you go, oh my gosh, did they give me a 20 or a 50? You don't know. So there are mistakes that occur. But if it happened all the time, then either you're really bad at your job or you're stealing. So each way you've got to go.
I remember a customer gave me $100 instead of $50.
Oh gosh. Yeah.
I'm not sure. It is $100.
Yeah.
So he was like appreciating our
Yes. Yes. Yes.
That appreciation was both for me, and I was happy.
Yes, that's right. It was. It's lovely when someone is honest with you, and a lot of people are honest. You know, they don't want someone to be out of pocket because of them. You know, they just take etc. So we've got staff training. What did you say, Jacqueline, before? I can't remember what else you said in the first one. FC. Yes.
You have the menu, but you have products, for example, 2 pieces of chicken.
Yes.
2 pieces with, I don't know, several certain amount. But you have another with 2 pieces of chicken plus fried chips.
Yes.
What happens sometimes, the cashier can select it. If you're buying as a cashier, I can select in the system that one, which is cheaper, but you are a customer and you are paying for this one, which is more expensive.
Yes.
But I can share and memorize that, and in the invoice, I put that product that costs less, and I'm going to get the extra.
Okay, so what other practice should you be encouraging to stop that from happening?
For that kind of shops, they don't control their potatoes, for example, as an extra product.
Yes.
Yes, they used to count the chicken.
Yes.
The piece. So that's okay. So they are selling the piece and that the stock management is okay, but there are 2 products.
Yes. So what should we be encouraging people to do to try to prevent that from happening? What should, if it was my shop, what should I be telling you as a cashier to do every time you make a sale? You give the customer a receipt.
Yes.
You must give the customer a receipt. Now, some customers will say, I don't want that, but you need to offer them a receipt. That way the customer will look, $6.20? I thought you said it was $8.20. So that's a control. That's an internal control. That's a good example. Another one, I worked for KFC. I worked for KFC when I was going through uni. I think everyone worked for something. The uniform. The uniform that you wear, no pockets. If I'm going to steal cash from something, what am I going to do with it? Where can I put it? It's got short sleeves, no pockets. I've got nowhere to put this stuff. So that's a control, which is why a lot of places insist that you wear their uniform. You can't wear your clothes. Yes.
Like we used to do this when we were working with friends, I think, but no more.
Yeah. So we've got to think about this, and these days it's very easy to set up video cameras. In places where you have high turnover of cash, like in hotels where they have big bars and people are there at night time drinking a lot and the cash is going everywhere, the drinks are going everywhere. How easy for a bartender to pocket some money. The cameras will pick them up. So nowadays it's very easy to have the cameras situated around the register and on the bar, because a lot of practices are that people leave their money on the bar, which always amazes me. I can't get that. And then they just get the bartender to take the money. Well, how easy, just take a whole lot of it. They don't know what they're drinking. They don't know what they're paying. They've had too many drinks anyway. They probably don't even know how much they got. How tempting it would be, that incentive, that opportunity there, to just take money that this person has just left there, and obviously means nothing to them. They're going to spend it all anyway. That opportunity is so enticing for people if you're in trouble financially. So the cameras are very good for that. And also having a senior person working around the bar area and keeping an eye on things, just observing. So they are all internal controls. And I'm sure most people have experienced that in one way or another, but you would never think of it being an internal control. And then as an auditor, I would go in and I would check to see if the cameras work. How often do they review the cameras? Now, they might only review the cameras if the cash register doesn't balance. Don't know. Or if they think, gee, the takings were down a bit in this past hour, because these days they can get their hourly or even by the minute records of sales. They go, gee, I thought it was more active that time, but the cash receipts are only to that. We'll check the cameras for that period and just see if anything's going on. So there are a lot more opportunities with the technology that exists. Control risks and tests of control. So the control environment may reduce the potential for material misstatements due to an inherent risk. The auditor must test and test the design effectiveness and the operating effectiveness of internal controls and over sales. And I've said this over and over again. It's a big difference between having a well-designed control and having a well-implemented control. I could have a control that is really well-designed, but nobody uses it, or they don't use it properly. Or I could have a really bad control, and yes, it gets implemented, but who cares? It's a bad control, it doesn't work. And I've come across a lot of those over the years where people waste their time doing something or other. They go, yes, but that doesn't matter, because even if it gets to that point, then someone can walk off with it and we still don't know what it is. So you need to look at both aspects of that for sales. Based on results of tests, we're going to make a final assessment of control risk so that I can then design the substantive plan, the substantive tests. And I've just indicated here tables 14, 1, 2 and 3 have control risk assessment procedures and planned tests of controls. It's well worthwhile having a look at that. It would be too boring to go through them like this, but you need to just have a look at them. So then I'm up to the substantive testing section. We've done our tests of controls. I've got to consider my acceptable level of detection risk. So based on my assessment of control risk, is it high, medium or low? That will determine my substantive testing. And again, I've got a reference to the textbook, page 603, table 14.5. And in that table, it shows you all the standard substantive testing tests for accounts receivable. So practical examples of tests. Now, when I'm doing my substantive tests, before I really start specific tests, I'm going to carry out some what we call initial procedures. And that is to make sure I'm starting with the right opening balances. We can't assume that the opening balances are correct. We've got to audit the opening balances too. So I want to trace the opening balances in the balance sheet back to the previous year's closing balances, and they should be the same. If they're not the same, something's wrong right from the start. So I need to establish that they have correctly closed last year and carried it forward to this year. Sounds simple, but we need to be sure of this. We're going to review the activity around the balance, the accounts receivable balance, to see, is this expected? Has it increased a lot? Has it decreased a lot? What sort of activity surrounds accounts receivable? Are there lots of transactions, a few transactions? And we're going to make sure that the balance that we've got for accounts receivable in the financial statements is the same as in the trial balance. As I said, it all sounds pretty simple. It's a bit like when I mark assignments. You know, you've done it here. Did you actually carry it through to there? But that's what we're doing. That's essentially what we're doing as an auditor. And I'm going to carry out some analytical procedures. And I'm going to carry out those analytical procedures to see if there are any areas that are a particular concern to me. Once I've got all that preliminary information, I'm going to design my test of details of transactions. And I'm going to do my test of details of transactions before I do my test of details of balances. So I will vouch accounts receivable. What does that mean? Vouch accounts receivable.
Through invoice.
Check backwards to see if I've invoiced. Yes. Cash payment, cash receipts from customers.
Yes.
Yes. So are they genuine sales?
Yes.
Have I received payments for them? That would be vouching. Have I got evidence that these are genuine balances? Yeah. A current existence. That's right, existence. Then I'm going to test sales and cash receipts cut off. Have they included all the transactions for this period and nothing that shouldn't be there? And then same at the beginning of the period, if you've got things that have carried over that shouldn't have carried over, etc. So I'm going to test for cut off. And once I've got the results of those tests of transactions, I will design my tests of details of balances. If I do these tests of transactions and find lots of mistakes, lots of errors, then I'm going to have to do more tests of details of balances than I originally decided to do. Because those misstatements that have occurred in the transaction is not supporting my level of control risk. So if I had a low level of control risk, I think controls are good. And then I go through my substandard test of transactions, and I find out there's lots of mistakes, lots of errors occurring, then something's wrong. Some controls aren't working. Some of them might be working, but others aren't. But I can't rely on what's going through the system. And whenever that's the case, we go to the test of details of balances and decide, have I planned enough tests of details of balances to give me this level of plan detection risk? If I start to think, oh dear, this is worse than I actually thought it was going to be, that means I have to do more tests of details of balances. If not, if everything comes up nicely, yes, I thought it was control risk was medium. There's a few mistakes, you know, I'm coming up with a few substantive errors, but that's consistent with the level that then I continue on with my plan details of balances. But it's a very important step. We're always reassessing these things. You never set it at the beginning and then just go along with it. Always you're going to modify your plan depending on what you've experienced. And so I do my tests of details. For accounts receivable, I will always do external confirmations. It used to be compulsory to do external confirmations. It isn't any longer, but it's unusual not to. It's unusual to not do any. We usually do some external confirmations. The reason we don't want to do external confirmations is it's time consuming and it's expensive. And sometimes it's not all that reliable, especially if we do what we call negative confirmations, where you only ask the customer to respond if they don't agree with the balance. So you never really know whether they agree or not, whether they just don't care, or whether they never received the request in the first place because they're a fictitious customer. So depending on the type of confirmations you do, but an external confirmation is always more reliable than internal confirmations. If we can, we do confirmations, and that will give us evidence to suggest that the debt exists and it is owed to the company. So existence and rights and obligations for confirmations. Oh, and valuation. The other thing that I will need to do in terms of my test of details of balances is assess the adequacy of the provision for bad debts. That's a test of detail of balance. The balance at the end of the year, the provision. I'm going to evaluate the adequacy of those debts, and we'll go through some of the steps of what you would actually do for that. So the two balances I'm interested in is accounts receivable and bad debts. And I would test presentation and disclosure in terms of all those. But let's just have a look at the provision for bad debts. What would I do as an auditor? Firstly, I've got to work out, how does my client work out the provision for bad debts? How do they calculate it? So I need to have information from the client of how they do it. Do they just take a straight percentage of credit sales? Do they work it out based on the aging of accounts receivable? Has the percentage changed? What sort of things do they do? So I've got to get information about what they do and what they did in the previous year. I'll also look at what my analytical procedures have determined, because I would be looking at the percentage of bad debts this year compared to previous years. Sorry, the amount of bad debts this year compared to previous years, not bad debts, provision. The amount of the provision this year and last year, and the percentage of credit sales this year and last year. I would also consider any other things that might be important. If I'm working in an area where there's been a big economic downturn, I would be expecting there to be a higher provision for doubtful debts, bad and doubtful debts. I'll look at the age trial balance, which shows how long each of the debts is outstanding. And then I'm going to identify and list overdue and doubtful accounts, discuss each account with the credit manager, especially if they're 90 days and over, trace any subsequent cash receipts. Because remember, I'm doing this after the end of the financial year, so you would be expecting some of these debts would become paid. So if I don't confirm the debts, if I don't do a lot of confirmations, that's okay, as long as I can see the debts have been paid. So it looks like they're genuine. And then I would trace those subsequent cash receipts to make sure that they've been put through to the accounts that I'm expecting them to go to. I would also examine a customer correspondence, like I said earlier, if there's an issue with lapping, any way that things are being misappropriated, I might pick that up with customer correspondence. And fortunately, these days, a lot of it's done by email, so that's even easier to get electronic copies. And then I'm going to estimate the provision for bad debts, what I think it should be. And if it doesn't agree with what the client's got, then we've got to negotiate, and I've got to try to get them to modify their estimate so that I believe it's not a material misstatement. So that's the question I'm asking. After I've gone through all of that, do I come up with an estimate for the provision that is materially different to the client? And if I do, then I've got to start asking why that's the case. If it's because I think they have just been too conservative in their estimate, that's one thing. I can just work with them and negotiate that. But if I think there is something systematically going wrong, if I think that that there are some things pointing to a fraud, then I've got to investigate further until I'm not convinced, I am satisfied that there is no cause for alarm in terms of a systematic fraud. And if I can't satisfy myself, I've got to keep going. I've got to keep investigating until I am satisfied. Or I uncover the truth. So in summary, what we've done is go through all of the steps in an audit plan for the sales and receipts. And as I said, they're always an important and a material area for the audit. It's always going to be a major focus for audit. The major inherent risk is the overstatement of revenue and assets, and the major risk is the misappropriation of cash, which we're always concerned about in terms of fraud. So sales and collection, that's what it gets to. Now, I wasn't going to go through the next chapter, but I just want to show you a couple of things that are different, just so you can see the significance of that. Let's just look at inventory. We're going to look at inventory and the testing of inventory with the various management assertions. The management assertions I'm mostly worried about is that industry exists, it's complete, where it is our stock, it is our inventory, so we've got the rights to it, and it's been accurately valued. I won't go through all of these, but look at the inherent risks. They're really different to the inherent risk associated with sales and collection. Often this is high risk. We've got high dollar values for assets, and it's part of current assets, and current assets, of course, is very important in the calculation of the current ratio. So if an organisation is wanting to improve its current ratio, inventory is an area that they might be trying to overstate. Generally, there are high volumes of transactions. They can be located at different areas. They can be in transit. The counting of inventory can be problematic, and the potential for shrinkage in some areas, what we call shrinkage, losing inventory. So some of it becomes lost, it becomes obsolete, the valuations are subjective, and it's a very easy one for management to manipulate the balance of because of the valuation of inventory. Remember, we value inventory at cost or net realisable value. So there's a decision there. So if I overestimate the net realisable value, I can be overvaluing my inventory considerably. And you would be looking as an auditor at trends in relation to this. So we'll leave it at that. I won't go through all those other slides because it does become a little bit monotonous, but you can also go through and have a look at the different tests with inventory and then with property, plant and equipment. And inventory is an important and a material item, again, in retail and manufacturing organisations. So I will leave it at that. Do you have anything that you want me to go through?
Susan, I have a question about my class about difference between test of detail balance, and test of
transactions.
Test of transactions.
Okay.
Yeah.
Tests of transactions. Like, we've got two ways of determining whether the financial reports are correct. One is to concentrate on closing balances and to try to decide, does this inventory exist? Is it correctly valued? Do these liabilities exist? Are they this company's liabilities or somebody else's? There are two ways I can do that. One is to look at all the transactions that make up that balance throughout the financial year and test them. So if I determine that all of the items that were recorded against inventory did actually exist, they were valued correctly, and the perpetual inventory system seems to be working. Every time they take inventory out of stock and sell it, it seems to get recorded. And if I check an invoice, it matches what's been done in the inventory system. They are tests of transactions. And if all the tests of transactions show me that there are very few or immaterial errors, I would be partly persuaded that the inventory balance is correct. So if I can see everything is going on, what should be recorded is recorded, it's recorded at the right amounts, it looks like only the items that should be recorded have been recorded, and all of that, I can test all of these transactions, and those tests of the individual transactions will go some way to persuade me that the figures in the balance sheet are correct. But there's another way that I could test that as well. I could test to see if the inventory figure is correct. Instead of going through all the transactions that made up that, I do tests of details of balances. in which case I don't care how that inventory figure got arrived at. I don't care how you recorded your purchases, how you recorded your sales, whether your cost of sales is correct or not. All I want to know is if you say you've got $1 million worth of inventory there, I want to know that it's $1 million worth of inventory and you've got it there at balance date. I'm going to test the balance, and the best way of doing that is to count it and look at it and test the value at balance date. So I'm not going to spend my time doing all those transactions. There's too many transactions to worry about maybe. I will just do tests of details of balances, or I'll do a combination of both. Now, the test of details of balances is telling me what exists at this stage, not how it got there, which is all right, but you know, I need to really know if things are working properly in this organisation, because there could be other things that are going wrong out there, and I won't know that if I just test the balances. I won't know that things got misappropriated 6 months ago and got written off in a different way. That, yeah, okay, your ending balance might be correct, but wow, how did you get that balance? Yes, well, we put through all these adjustments. So I need to do both things. I need to test the transactions that make up the balance, and then I need to test the balance itself. And if you think in terms of existence, if I want to know that stock exists, I've got to do a test of balance. No point doing a test of transaction. It's not going to tell me if it's there or not. It could have gone. It could have, yes, the transaction, the stock came in. It was valued at this, yes. But where is it? Someone stole it. The only way I can determine that is to do a test of balance. On balance date, let me have a look at that stock item.
So test of balance is mostly at the end of the year?
It is always at the end of the year.
Always?
Always.
Transaction?
Throughout the year.
Throughout the year. But like in this question, sometimes I'm confused.
What's that?
Ensure the interest paid on the bank loan is correctly by multiplying the interest rate by outstanding principal for each month for the year. So it would be test of balance.
That's an analytical procedure. Hang on, what did you say? Test.
Ensure that an interest paid on the bank loan is corrected by multiplying the interest rate by the outstanding principal for each month of the year.
A reasonableness test.
Like
yeah.
Analytical review.
Yeah, it's an analytical procedure that you would carry out to test the balance that you've got in there. It won't tell me how much did you pay every month, did it get recorded correctly, anything like that. But it will say, now let me, you've got interest paid. Is it interest paid? The balance of interest paid, the total amount of interest paid for the year. If I've only got one loan and I know the interest rate, I could get a pretty good idea of whether that balance is correct or not. Whereas if I wanted to test the transactions, I would go in and look at interest charged or interest payable or something or other each month and redo the calculations and see if each of those transactions is correct or not. Now, I might do that if I make this calculation, I'll come up with a really weird figure. I'll go, hang on, that's nowhere near what you paid. It's materially different to the amount they've got in their financial reports. Then I will go back and test the transactions. And I would say, okay, we better look in detail and see how they came at that.
Thank you.
Okay. Anything else?
So my question is, do I want to be answered?
Okay, so we'll leave it at that. I'm going to stop the recording.